NVIDIA just reported 85% revenue growth. The stock surged, Wall Street cheered, but hidden inside this earnings report is the one risk almost nobody wants to talk about. And if that risk becomes reality, it won't just affect NVIDIA, it could impact the entire AI trade. Hey everyone, on Deep Dive Stock Earnings, here, we don't just look at price moves, we break down the logic and trends behind them. If you want to truly understand how the market works, make sure to like and subscribe. Let's get right into it. Let's start with the most important numbers from NVIDIA's latest earnings report. The company once again delivered results that exceeded Wall Street expectations by a wide margin. Quarterly revenue reached an astonishing $81.6 billion, up 85% year over year, setting another all-time company record for a business that has already become one of the largest technology companies in the world. Maintaining near double-digit revenue expansion at this scale is extremely rare. More importantly, this earnings report directly answered one of the biggest questions investors have been asking over the past several months. Is AI infrastructure spending starting to slow down? At least based on the latest data, the answer appears to be no. Major cloud providers, internet platforms, and global technology companies continue investing aggressively in AI infrastructure. Concerns about AI capital expenditures, peaking or demand beginning to cool have been significantly reduced following these results. In other words, the global AI arms race is not slowing down. If anything, it continues to accelerate, and NVIDIA remains one of the biggest beneficiaries of that trend. When investors saw NVIDIA's 85% revenue growth, the first reaction was excitement. But the real takeaway isn't the number itself. It's what that growth says about the AI industry, because it shows that major tech companies are still investing heavily in AI. No industry can grow this fast forever. But for now, the demand slowdown many investors feared simply hasn't appeared, and that's the first positive signal this earnings report delivered. Beyond the impressive revenue growth, NVIDIA's profitability remains equally remarkable. According to the earnings report, the company's data center segment generated $75.2 billion in quarterly revenue, up 92% year over year and accounting for more than 90% of total company revenue. At the same time, NVIDIA reported a GAAP gross margin of 74.9% for a hardware company. That level of profitability is almost unheard of. Most hardware manufacturers compete primarily on price. NVIDIA operates under a completely different model. Through years of investment in GPU architecture, the CUDA software ecosystem, high-speed networking solutions, and AI development platforms, the company has built an exceptionally strong competitive moat. With AI chip demand still significantly exceeding supply, NVIDIA continues to benefit from both technological leadership and substantial pricing power. That combination allows the company to grow revenue while maintaining extraordinary profit margins. For long-term investors, profit margins can sometimes matter even more than revenue growth. Revenue can be influenced by industry cycles. Sustained high margins usually indicate a genuine competitive advantage. And today, NVIDIA's moat extends far beyond its chips. The company has built an entire ecosystem around AI development. That ecosystem advantage remains one of the biggest reasons investors continue assigning NVIDIA a premium valuation. Of course, investors are not only focused on past performance, they're also paying close attention to management's outlook for the future, and NVIDIA's guidance remained extremely strong. The company expects next quarter revenue to reach approximately $91 billion, while management projects GAAP gross margins to remain around 74.9%. The primary driver behind that optimism is the continued rollout of the Blackwell platform. As major technology companies accelerate AI infrastructure deployments, Blackwell has quickly become one of the most anticipated product cycles in the industry. Management indicated that customer demand remains exceptionally strong. As production and deployment continue to scale, Blackwell is expected to provide another meaningful growth catalyst over the coming quarters. From Wall Street's perspective, that means both current demand and future growth expectations remain healthy. Past results matter, but stocks are priced based on the future, and this earnings report reinforced confidence in the Blackwell cycle. The challenge is that expectations are now extremely high. Going forward, NVIDIA doesn't just need growth, it needs growth that continues to be what investors already expect. And that's what will matter most for the stock. In addition to strong operating performance, NVIDIA's cash generation remains extraordinary. the company reported quarterly net income of $45.5 billion, demonstrating the powerful operating leverage embedded within its business model. At the same time, NVIDIA's board authorized an additional $80 billion share repurchase program, further increasing its commitment to returning capital to shareholders. For investors, cash flow often provides one of the clearest pictures of a company's true financial strength. Accounting earnings can sometimes fluctuate based on reporting methods. Cash generation is much harder to manipulate, and right now, NVIDIA is producing cash at an exceptional rate. That financial strength allows the company to continue investing heavily in research and development, while simultaneously rewarding shareholders through buybacks. For long-term investors, that combination remains highly attractive. Many companies can achieve growth. Far fewer companies can simultaneously deliver rapid growth, high margins, and massive cash flow. That's one reason why institutional investors continue maintaining large positions in NVIDIA. Of course, stock buybacks don't guarantee higher share prices, but they do signal management's confidence in the long-term outlook of the business. Beyond the financial numbers, Jensen Huang's comments during the earnings call attracted significant attention. According to management, the AI industry is entering another major transition. Historically, most attention has focused on training large AI models. Going forward, a growing portion of demand may come from inference workloads and agentic AI. Jensen repeatedly emphasized that agentic AI is becoming one of the most important growth opportunities. In the next phase of AI development, the company also introduced its Rubin platform, designed to support future AI infrastructure needs. Whether it's enterprise AI agents, autonomous vehicles, robotic systems, or edge computing devices, all of these technologies require continuous computing power to operate. As a result, future demand may increasingly come not only from training models but from running them at scale. Meanwhile, NVIDIA continues expanding its presence in robotics, autonomous driving, and edge AI applications, positioning itself for the next wave of industry growth. If agentic AI eventually reaches large-scale commercial adoption, demand for computing power could continue expanding beyond current expectations. Unlike training, which typically occurs once, AI systems may require ongoing inference workloads on a daily basis. As a result, many institutional investors are increasingly paying attention to inference demand alongside training demand. For NVIDIA, this could potentially represent an additional source of long-term growth if adoption trends continue to develop. However, despite the strength of this earnings report, one important risk continues to emerge beneath the surface. And surprisingly, that risk isn't AMD. It isn't another AI chip competitor either. The real risk is the market's growing dependence on continued AI capital spending. Today, companies like Microsoft, Meta, Alphabet, and Amazon remain the primary drivers of global AI infrastructure investment. Management also disclosed that hyperscale customers account for nearly half of data center revenue. In other words, NVIDIA's extraordinary growth remains heavily tied to the spending decisions of a relatively small group of technology giants. At the same time, geopolitical risks remain relevant. The company reported approximately $5 billion in inventory-related charges tied to export restrictions affecting China. Management also excluded China data center revenue from its forward guidance. If future AI investment returns fail to meet expectations, or if major technology companies begin slowing capital expenditures, the entire AI ecosystem could face growth pressures. And that's the key takeaway from this earnings report. The question isn't whether NVIDIA is a great company. The question is whether it can keep exceeding already sky-high expectations. Going forward, the biggest factors will be AI spending and Blackwell execution. So what do you think? Can NVIDIA maintain this growth? Let me know in the comments. Like and subscribe to Deep Dive Stock Earnings. See you next time.